It's Doug McIntyre, the editor-in-chief at 24/7 Wall Street, and I've got Lee Jackson with me. Lee has been the senior editor here for finance and covering corporate communications and stocks for a long time.
A long time.
A long time. So we're right at the end of earnings season. Maybe two or three companies have to report still, but it's pretty much done. Oddly enough, just as we're ending, there's a threat that the market could really fall apart. So, what's happened? Why today, or why this week?
Well, I think they were certainly surprised by the uptick in the CPI number for January. That was a huge surprise because everybody was saying, oh, it's going to fall. It's going to fall. Didn't fall. And then the retail sales numbers for January were way below estimates. And despite some good earnings, and especially mega tech earnings, the great bulk of the S&P 500 is just kind of treading water, it appears.
People get misled. They look at the S&P in general. It looks, well, it's going up, 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 up. What's really going up? What's driving it?
10 major stocks, Doug, in the S&P 500 now account for 35% of the total market weight. 10. So the other 490, many of which are trading below their 50, 100, and 200-day moving average, are literally discounted, and you're essentially buying a third of the index when you're buying some of these big upside days.
Do those stocks deserve it? I mean, if they're driving it, do they deserve to be in the driver's seat?
They did a year ago. The question is, after such a magnificent run for Nvidia and Meta and Microsoft and Google and Alphabet and all those, the question is, are they fully valued here? And it would, from a metrics standpoint, an earnings standpoint, I mean, some of them are trading at 30, 40, 50, 60 times earnings. Probably can't grow their income 60%. So I think we're at a precipice where institutional sellers could come in and say, time to take some money off the table.
When people look at these mega cap tech companies, I think they think, wow, they're all the same. You can take one and replace it for another, but it hasn't worked that way, has it? If you look at the sort of the wide spectrum, Meta did well, Nvidia
very
well, but a couple of these stocks like Apple are really struggling. And are you starting to see a departure? I don't know if it's the hardware stocks and the software stocks. What's happening? They're not all trading up.
Well, I saw today a headline that it was kind of amazing, but not surprising. Whereas Buffett, who, that's his biggest position and the largest part of the Berkshire Hathaway portfolio, he's selling stock. So when Buffett thinks it's fully valued, it probably is.
Let's pretend we're Warren Buffett. We've sold some of our Apple shares. So do I. I wish so too. He pretty much buys household names. It's very rare you look through his list and say, gee, I don't know that company. If you cashed out of Apple right now and you're Buffett, love big brands, where would you go?
Well, for years, he held off on buying any technology to speak of. And then when he did, he loaded the boat on Apple. I don't know if there's any of the major companies like a Microsoft or a Meta or Alphabet. I don't know if he would go down that road. You would almost think, I think he has 157 billion in cash. You would think he's maybe looking to throw some more money on the cash pile and maybe wait for a big sell-off or wait for a big correction sell-off and either grab something he likes lower or already has, or uses it for another private stake.
Here's an interesting question. He's owned a lot of banks over the years. Stock market goes down. Leave aside regional banks. Big banks, up or down?
I think in the near term, while maybe for the next week or two, the easiest way is maybe higher, but I think soon we will see a sizable 10, maybe even 15% correction in big tech. But again, what has the mantra been for the last 4 years? Buy the tech dip, buy the dip, buy the dip. And after we had this big sell-off day, after the CPI numbers, which was a massive sell-off, they were in there buying the dip right away. So, I mean, long-term portfolio managers aren't doing that. It's hedge funds, because they can get in and do huge algorithmic trading that is already programmed to buy a 6, 7, 8, 9% dip. So, I don't know. I don't think Buffett's going to be looking to buy the dip, but I could be wrong.
So if you're an investor, typical average investor, in your 60s, you don't like the market right now, where do you put your money?
I think, again, what was it, Gunlock, that said the best trade is T-bill and chill? And that's probably still good advice, because you can get 1-year paper, yielding 5.25, 5.30. And there's also, an exchange traded fund that's symbol BIL, that is a short 1 to 3 month treasury that pays monthly, has zero swing in NAV, really, just because they just pay distributions monthly, and that's the extent of it. And I think in the short term, if you're 60, that's probably the safest idea, or even monthly pay CDs, which you can get at any broker or directly through your bank. And, the brokered CDs have raised a ton of cash for banks.
So people know, what's the yield on that?
On which one?
The one you just mentioned.
On the BIL, which is, I think the yield's like a 4.90, because it's set up as a 1 to 3 month treasury yield, but I think they have debt out to a year, so a 1-year T-bill. And remember, all of those don't pay interest per se. They accrue debt and pay you like a savings bond. If you bought it at, say, 900, it accrues to 1,000. And what they probably do in the structure of this fund is they have stuff coming due every month. So that's how they take the accrual to pay the dividends to shareholders.
How bad could this get if it really takes a hit? And let's look at it this way: the market goes back to average valuation on the S&P 500. Where does it go?
If you're talking about 18 times earnings or something that's historical,
you're
looking at a 10 to 15% sell-off, if not more. I'd have to check the exact numbers, but it would be big, because I think the S&P trades at about 22 times now. I'd have to look. I'm sorry.
Maybe more than that.
Yeah.
What is the argument, if there is any, that the market keeps going up? Because some people say, well, it's got a long way to go, and that sort of, at this point, maybe nonsense.
Well, if you're the long-term proverbial investor, it's a 90-degree slope and always has been, and you and I were around when everybody was wearing Dow 10,000 hats. That was a long time ago. And I don't think I have my Dow 10,000 hat anymore, but like any big market move higher, you go through the thing where stuff is totally overvalued and everybody's in despair, and then it starts to move that trend higher, and then you get accumulation, and then you get euphoria, and then you get like almost manic buying. And it's the, and it's been an acronym they've used. The FOMO, or the fear of missing out, drives a lot of money in. But again, I think it's mostly hedge fund money. It certainly isn't Vanguard or people of that nature, I wouldn't suspect.
Let's take a step way back. Taiwan, Middle East. I think Russia now apparently has weapons that they can put nuclear satellites in orbit. A lot of stuff that you could see go wrong that's big. I don't mean like the stock market goes down for a couple of days. What's the mentality in the market right now if something geopolitically happens that's of real substance?
because of the influx of money, Doug, since the beginning of the COVID pandemic, they flooded the market with money. And so it's been just that. It's been a pile of money, but investor savings rates, which are generally around 10%, have dropped to 3%. And that's a lot. And more of normal retail or consumer debt is going on credit cards. And we're going to get to a point we have over 1 trillion in credit card debt in the United States now. And there's going to be a point when people run out of money. And like you said, combined with a big geopolitical explosion, and it could be in numerous places. It could be in the South China Sea. It could be in the Middle East. It could be in Ukraine, Russia, in that battleground. I think we're fighting a lot of proxy wars, and and especially with Iran starting to use their proxy armies to attack us. I think that something could give big, and it would probably be caused by geopolitical disruptions.
We're just starting to see credit card defaults tick up. Long-term car loans, the 60, 72-month, deals that, you walk into a dealer, it's like 0% for 99 years, but after the first year, it goes up to 9%.
Right.
What does it
kind
tell
of a teaser rate?
Yeah. What does it tell you that you're starting to see defaults?
Well, same thing we've seen for years. I mean, there will be foreclosures and there will be car repossessions. And what will happen when things get difficult is there will be no gigantic new car sales and big appliances. Anything that's people will start to put it off. And then those retail numbers like we saw for January, which were well below estimates, they could all start to drop.
Yeah. Well, this has been a great conversation about sort of the market in general at the end of earnings season. So you and I will catch up again in a few days and move on to the next big topic. Thank you.
Yep. I look forward to it, Doug. Thanks a lot.